Hi, can you guys hear me? Perfect. So my name is Tribh Grewal. I work at Discover Global Network, and I lead our fintech partnerships team in the business development area, primarily working with fintechs that are bringing in new solutions to the market. But I'm here to talk about PSD3, third time lucky. So before I go forward, our legal department said I must show this, so you know that this is what I think of PSD3, not what anybody else thinks. So anything I say, please take that as my view. So you'll be wondering who's Discover. So Discover is a Fortune 300 company based out of Chicago, US. And we work in two areas. So we are a direct-to-consumer bank, and we provide all the banking services in the US and have done so since, I think, about 1986, so about 30-something years. But the other side of Discover is Discover Global Network, which is what I am part of. And Discover Global Network is Discover Network in the US, which is a full payments network serving the US market. We have Pulse, which is the PIN debit ATM network in the US. If you've ever seen the US cards from even other schemes with Pulse logo on the back, those are cards that are issued and operate on our ATM network. And then internationally, we have Diners Club International, which is part of Discover, and that's our international brands for card issuing and acquiring. So just one more on Discover. So we issue cards around the world, as I said. We are the fastest growing network, and that growth has come through not just our partnerships with our franchises, which are banks around the world that issue Diners Club cards, but we have a different strategy, which is to partner with local networks. So we partner with over 25 domestic schemes and domestic networks, and the benefit of that is we share our technology, we share our operating regulations with those domestic networks for them to launch in their own markets. But when those cards travel outside of their domestic markets, they operate as a Diners Club Discover card on our network. So we provide international acceptance and usage to our domestic scheme partners. The benefit we get from that is our cards get accepted on their local networks as a domestic card, so our acceptance grows. So that's where the synergy between us and our partners is around the world. So that's enough on Discover. So let me move to the next topic, which is the most exciting one. You've probably seen a number of other presentations that have talked about regulations, various aspects of regulation. So I'm just going to look at what PSD3 is. And over the last few years, we've seen a huge change and transformation in the payments industry. And that's not just for various reasons. There's a lot of innovation. There's a lot of digitalization in the market. And as that has grown, we've seen the risks and fraud grow with that as well. So it's only important that we look at regulating the market so that we can create innovation, we can create disruption, and we can have a robust regulatory environment to manage and control those risks. Because without right regulation, it's going to be chaos out there, right? So the benefit is to look at how we can manage and control the risk, how we can increase competition, and how do we, more importantly, look at increasing consumer confidence, because unless consumer confidence is there, anything we do is not going to happen because consumers are not going to be using the payment services that are coming up. So that's where it's important. But before moving forward, I'd just like to level set. So I'm sure you all know this, but just a difference between a directive and regulation. So directives typically tend to be much wider in scope. They are a set of goals that the regulators require the member states to follow, and they're within certain timelines. But the downside of directives, if I can say that, is they're open to interpretation, because every local national competent authority, every regulator looks at the directives and they implement them and transpose them into their national law based on the local requirements. So there's a lot of scope for, you go to one country, it's a completely different interpretation and implementation of a particular directive. Regulations, on the other side, are very narrow in scope, and they are very precise. And they are implemented as is, so there's no room for interpretation. Whatever is said in the regulation, that's implemented as is across all of the member states. And they come into force the day they are implemented or they are required, the day they come into force, right? So there's no time frame for any implementation requirements. So let's just look at the history. So we said third time lucky, so what were the first two times? The first time, the PSD1, came effective in 2009, so a long time ago, and a lot has changed since then. But the objectives of PSD1 were to harmonize the EU markets, and that was to make sure that intra-EU cross-border transactions have the same safety, same precise requirements as domestic transactions within the EU. So it was limited in scope just to the EU. It introduced competition, it introduced new entities, new entrants to the market. It created rules around payment institutions. But the thing with PSD1 was it created SEPA and established some consumer protection rights. There weren't very many before, but it had some new consumer protection rights that came in, but there were weaknesses, right? Because when it was designed and by the time it got implemented, the landscape had changed. There was very little on security, right? E-commerce and mobile were taking off, so there was very little on how you protect those transactions. And it was a directive, so the interpretation amongst all the member states were different. So you could go from one state and have totally different understanding than another country. So then along came PSD2, because we had to improve on that. So PSD2 was designed primarily to, again, grow the competition, to provide some consumer protection and also improve consumer rights, right? It introduced a lot of new acronyms, right? So, they're all difficult to pronounce, the AISPSPs and the ASPSPs, and so many of them always difficult to remember. It introduced the concept of strong customer authentication. Strong customer authentication or customer authentication was around for a long time, but it introduced the requirements to implement strong customer authentication. It also introduced the idea of open banking, so opening up the non-bank participants to come into the market and compete with the banks, right? It made requirements for how those entities cooperate and work with the banks, how the consumer rights are safeguarded. But again, there were challenges with that. Being a directive, the implementations were different. Strong customer authentication was good, but it created a lot of friction in the market because everybody implemented it slightly differently. And there was a requirement on having the smartphones or two different types of technologies, or how you implement that. But the interesting thing with PSD2 was it actually increased the scope of the directive. So as I said, PSD1 was primarily intra-EU. With PSD2, the requirement came in for the third leg. So if there was an entity that was based in the EU, anybody working with that entity, so let's say, give an example, if a merchant is in the EU and the acquirer may be outside of EU, that acquirer had to comply with the EU requirements. So that was a third leg principle which actually expanded the scope of PSD2 to outside of the EU. As I said, with the requirement for SCA, there was a friction, but there was also digital exclusion, because unless you had the right technology, unless you had the right access to the payment systems, you weren't able to use it. Right? And there was lack of enforcement because of the different interpretations across all the markets. How you enforce the regulations was becoming difficult. There was a lot of form shopping or regulatory arbitrage. So you look at, okay, country A has very little relaxed regulatory environment. I'll go there rather than country B, which requires me to pass through a lot more hoops. So if I look at PSD3, the underlying principles of all the regulations haven't changed. whether it was PSD1, whether it was PSD2, and now even with the PSD3 proposal. Those things haven't changed, and those are increasing consumer confidence, increasing security of transactions, cutting down on fraud, making sure that there's access to the payment systems. So if you look at the first one, which is enhanced consumer protection. So there's requirements that are coming in or being proposed in PSD3, which require banks to simplify the way they communicate with their consumers. By that I mean is there needs to be clarity on the statements. When you produce your financial or bank statements or whatever, the information about the transactions need to be there. There's things around fraud protection, right? Things around making sure that there's transparency in FX rates. So when you're doing cross-border transactions or you're doing money transfers, the FX rates are clearly displayed. Any fees and charges are very clearly shown to the customers, so they know exactly what they're going, how much are they paying, how much they'll be charged, when the money will get there, and if there's any fraud, they'll get refunded, right? So that's about building consumer confidence in the payments market. And then we look at the harmonization of the environment. That's about enforcement of providing the national competent authorities and the regulators enforcement powers, and the powers to actually penalize any parties that don't follow or don't comply with the regulations. It also talks about tackling financial and digital exclusion, which means with all the digitalization, people still need access to cash. So people with accessibility requirements, whether disabilities, people don't have the right technology, they need to be able to access cash. So there's very clear requirements in PSD3 to be able to get access to cash at ATMs or even at the retailer. So there's now, you used to have the purchase with cashback. That requires me to expand it to you can have cashback without a purchase, right? So up to 50 euros. So that's a way of making sure that people get access to cash. It's also looking at how we improve the accessibility for non-bank PSPs who had challenges in working with the banks because they're required to have safeguarding accounts. They wanted to have access to account data. And banks seeing the non-bank PSPs as competition were a little reluctant to provide that information. So this is providing clear requirements that non-bank PSPs will have direct access to payment systems, whether that's clearing systems. So under the settlement finality directive, it is now clear that all the commercial banks, unless they have very good reasons to not open an account for somebody, they must provide access to the customer data and to bank accounts. And open banking came with PSD2. So this is looking to improve the open banking services. So that's making sure that there's standardization in communications and there's standardization APIs, how data is exchanged. So making sure that anybody who wants to launch open banking services has access to the right data at the right time, and and it works. So that was the background to, or what I see the main pillars of PSD3. I mean, I've seen people talk about 8 or 9, but to me, those are the 4 main things: consumer confidence, harmonization, level the playing field, right, and improve open banking services. So what does PSD3 look like? So up until now, we had PSD2, and there was a separate e-money directive. With PSD3, the proposal is to merge all them together and create 2 separate legislative instruments. So there's requirements under PSD3, which are all about supervision and enforcement and around cooperation amongst the regulatory authorities. Then PSD2 becomes PSR, or Payment Services Regulation, or PSR1, because I'm sure there'll be a PSR2 at some stage, right? So it becomes PSR. And that's all about providing a framework for PSPs and the banks to operate in. It's looking at how the rules and the enforcement of rules is harmonized across all the member states, and ensuring that there is direct access to bank accounts and payment systems for all non-bank PSPs. Right? There's even a proposal states that central banks, who up until now have not been involved in providing safeguarding accounts, etc., central banks have now, if they choose to, can provide safeguarding accounts to banks if the commercial banks cannot provide that. Sorry, if I speak too fast, raise your hand and I'll slow down. But I'm just trying to make sure that I finish that in time and leave some time for questions. So if we look at PSD3, so to me, PSD3 is the softer side of the regulation. And it's looking at merging. So today we have the e-money institutions and payment institutions. They both have slightly different requirements and operate in a slightly different regulatory environment, but the aim is to simplify that, merge those two, and create a single regulatory regime for payment institutions. So once PSD3 comes into force, EMIs will cease to exist, and they will become PIs. And that's an interesting area, because that means all the EMIs and the PIs will have to re-register, reapply for licenses, and get the permissions approved. And there's other requirements. Again, I talked about consumer confidence and protecting people's money earlier. So there's requirements around safeguarding. So EMIs, I should stop saying EMIs, PIs, in future will have to have multiple safeguarding accounts, and that's to avoid the concentration risk, because if they have a safeguarding account with one bank that fails, then the money's gone. So the objective is they must have multiple safeguarding accounts, and commercial banks, like I said before, cannot say no unless they have very good reasons, whether it's AML or any of the sanctions related stuff. Commercial banks have to provide those safeguarding accounts, and alongside the commercial banks, central banks in the member states can provide those accounts as well. But it also sets out rules around the information that the PIs need to provide as part of their re-licensing and re-registration. And that includes very robust risk management, looking at wind-up plans, data and operational resilience, right? And also, what's the word I'm looking for? Anyway, it's gone. But the objective, as you can understand, is to make sure that all the non-bank PSPs are managed under a single regulatory regime, and they are providing all the services safely and securely, and hence all the regulations around the re-registration. So the EMIs and PIs will have, they'll be grandfathered in if you have licenses today. You'll be grandfathered in, but you have 30 months, but after 18 months, sorry, 24 months, not 30 months, within 18 months you have to reapply for the license. So that's the requirement. So you can operate for 2 years, but 18 months you must submit your application, and that's in order for the national competent authorities and the regulators to review your application, check your plans, and then grant you the license. So then we have the other side is the cooperation amongst the national competent authorities. So, and as I mentioned before, up until now there's been a lot of form shopping and regulatory arbitrage. So this is making sure that the supervision and the enforcement is exactly the same across the member states, right? So there's no room for maneuver or different understanding. The other side of PSD3 is about financial inclusion, so making sure access to cash, and there's requirements around payment account holders or companies that provide payment accounts and companies that purely provide cash disbursement services like ATM providers, right? So ATM providers, and I had this question yesterday from somebody, ATM providers are excluded from the requirements, but there may be a new registration or licensing requirement, a lighter one coming for them later on. But today, pure ATM providers are not going to be included in that because they're not providing any payment accounts. There's also a separation, so until within PSD2, the issuing service providers and acquiring service providers, they were under one entity. And now this proposal is to separate the two so that there's clarity whether you're providing issuing services or acquiring services. And then there's things around clarifications and of definitions. So what is, around passporting, around what is a payment application and what is a payment service. So as an example, things like the Google Wallet, Apple Pay, those are now outside of this because they have been classified as payment applications, right? But on the other side, if you're using any of the third-party processors, you must have outsourcing agreements with them, and those must include things like auditing, regular checking, and reporting, right? So it's going to be very important for anybody who's using outsourcing services to update those agreements and make sure that they include all the requirements that are published within the directive. So that was PSD3, now PSR. So I see PSR covering 4 key pillars, right? One is fraud prevention. That is the key item. I think there was a presenter before me who talked about, all about fraud. So it is top of mind today because if you open a newspaper or listen to the news, it's always about APP, which is authorized push payment fraud, or spoofing, where somebody pretends to be from the bank, or various other types of frauds. So the objective is to make sure that there's enough thought, enough processes behind the fraud prevention, and then there's liabilities and penalties associated with that. So it's under the consumer protection, but the point there is it's consumer-centric. So the consumer is always right, which means if you are a payment services provider, you are EMI or PI or a third-party service provider, you have to prove that the transaction was fraudulent. If you cannot do that within 10 days, you must refund the money. Now, that could be good or bad thing. It's consumer protection. Consumers are getting their money back, but that could give rise to some bad behavior because if you know, well, I'm going to get my money back, you may not do all the things that you as a consumer are required to do. And it's also making some recommendations and requirements. I shouldn't say recommendations, some requirements around SCA. And that's around accessibility. So making sure that everybody, whether, looking at disability, people who don't have access to the right technology, the latest smartphone, can access the financial services just like anybody else, right? And this is where a slight change. So if you look at the typical definition when we talk about customer authentication or any authentication is, it's knowledge, it's possession, and it's inherence, right? It's something you have, something you are, and something you do. And up until now, it was you had to choose 2 of the 3. And what's changing with SCA is that you could have 2 of the same. So you don't need to have an OTP on your smartphone and a password, or biometric authentication. You could just do biometric authentication and OTP, or just do 2 passwords, which makes it accessible to a lot of people who may not have access to the right technology, or don't have smartphones or any other means. One other thing that's been added into the strong customer authentication is exclusion for merchant-initiated transactions, or MIT. So as long as the authentication is done the first time somebody signs up for MIT type transactions, you don't have to do that again for at least 180 days. It's up to the service provider if they want to do it multiple times, but the requirement is that it needs to be done once and it's valid for 180 days. And then it's about enforcement powers. So that's liability. I put down as liability because that's about enforcement. It's who's liable for any fraud, who's liable for things not working properly, right? And that goes to the third-party processors, the third-party service providers. And I mentioned the point earlier that they need to have outsourcing agreements. So if you're a payment service provider and using authentication services for SCA from another party, you cannot blame them for the failure of SCA for any fraud. Right? So the liability goes to the third-party service provider and to you, to making sure that SCA works every single time. And there's penalties associated with that. I mean, it's as high as 10% of your global turnover, not profit. You could be fined up to 10% of global turnover. And there's also periodic penalties in scope, which means you'll be fined X amount of dollars, euros, whatever, until you fix what was identified as a non-compliant element. And then about consumer protection, I've already talked about. It's about transparency, making sure that the consumers have access to all the information they need. They're aware of all the fees, charges, the margins you have on your FX rate above the interbank rate, right, to that level, and also guaranteeing that the monies are transferred, so that you need to also share the time frames within what the monies are going to be transferred. If you send money from here to there, and one thing I forgot to mention, which is around the confirmation of payee. So UK has had the confirmation of payee for some time, but there's an IBAN checking requirement that's coming in as part of the fraud protection. And that requires payer and payee's IBAN checking account, and that is within 10 seconds. Now, I'm sure it can be done, but if you can't do the IBAN checking across payer and payee within 10 seconds, the transaction has to be reversed, right? So there's a lot of stuff that is coming around around consumer protection and making sure that the consumers are not suffering from fraud. And then open banking services I've already talked about. It's about improving open banking. It's about making sure that the APIs are standardized. It's making sure that the communications are standardized. So I'm not sure whether I have time or not. I'm over. Yeah. OK, I'll take 2 more minutes and I'm done. So, and I thought I'll finish quicker, but anyway. So, in my view, there's a lot of impacts that are coming, and you need to assess your strategy. You need to look at your business model to see whether the business models comply with what you have. What are the legal and contractual requirements? So going through the full list to make sure that you are ready for those things. And I think UK would be ahead of PSD2 because from what I've seen, the UK regulators and the PSR talk about, their priorities are exactly the same as what PSD3 is trying to achieve. So we have confirmation of payee, we have SCA requirements, we have fraud protection. So there's a lot of synergy between the two. But I think UK might be just ahead of PSD3 because PSD3 is not going to be here until end of 26 or maybe early 27. And I'll stop there. Thank you.
Thank you. Thank you.